Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us today. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are fiduciary. Outside of Naperville, hopefully everybody knows that. We've sent many emails on our new location. We're really excited about that. So if you have any questions on income notes, if you have any questions on tax reduction, aggressive growth, obviously make sure that you reach out to Paige, set up that time, and we'll have our initial consultation, 630-492-1912, 630-492-1912. The insiders keep selling. Is that positive or is that negative? I think there's so many questions that we're having with individual investors who are not working with us. And, I think you look at where the market is going. Many people have been waiting on the sidelines, and I want to talk a lot about that today. I thought today we'd share some of the conversations that we're having with current investors as well as those that are interviewing us. Just because I think if they have the questions, there's probably a good chance that you have the questions as well. Obviously, when you look at kind of the market today, you look at Magnificent Seven, those seven stocks, they're 30 times higher when they were 10 years ago. That's exceeding gains of all other historical manias. Think about that. The NASDAQ 100 rose 12x in 10 years before the dot-com bubble. And we have exceeded that. And does that mean the markets are going to crash? Absolutely not. That's the challenge that investors have. The markets are just going to do. And when you have such concentration, right? You have such concentration at the top. This market on the upside can go on for a long time, much longer rather than, many people think. And I've seen far too many people sitting on the sidelines and missing out on the gains. And I had to stop and think why. And I think, first of all, they may not have a plan. And as you know, we hired a new certified financial planner, Brian, as part of our team. PhD level knowledge, in my opinion, of financial planning. We are so excited to bring him on. I know we have a lot of clients that listen to the radio show. So during our spring update, our spring portfolio review, we're certainly going to talk about that. If you don't want to wait and you want to talk about the financial plan, the new software that we're using, the new tax reduction software that we're using, just reach out, 630-492-1912, 630-492-1912. But many people have missed out. And, when we look at, things that have never happened before, I mean, these are real statistics. And when people hear those types of statistics of never happening before, they think that, the markets have to correct. And yeah, I mean, you look at what has never happened before, the top 10% of the largest U.S. stocks now reflect a record 75% of the equity market. That's a lot. I mean, the percentages even surpassed the previous record that was set before the Great Depression. But if we want to compare that to kind of the dot-com crisis, because, that is, something that's a little bit more in most people's memory. But by comparison, the 2000 dot-com peak, this percentage was only 73%. So the top 10% of stocks as a total percentage of equity market cap has risen almost in a straight line since the bottom of 2008. And When you look at, the top 10 stocks in the S&P 500, they now reflect, at least as of last week, a record 40% of the index. So the markets have never been so concentrated. And that doesn't mean that it's bad. I mean, I think when it comes to kind of portfolio management, and I think, when you look at, making sure that we have protected growth, and a lot of people have issues with protected growth. And, I want to talk about, protected growth and, how we look at managing money is we look at protected growth, growth plus, and then alternative and tax. And, obviously tax reduction is a very, very major focus of our firm. In the energy strategy, we have a fund that it is our fund, actually. And, that strategy can greatly reduce your taxable income. So for those high wage earners in the Chicago area, sold a business, sold a building, you just, have concentrated stock positions, significant gains. We can, and there are strategies that can greatly reduce your active or passive income. The energy space generally is going to provide you with the greatest tax benefits that are available of any investment. At least that's our belief. And again, we're not tax advisors. And so anything we talk about when it comes to taxes, please understand it's just for informational purposes only. And it's always best practice before you do anything to make sure that you reach out to your tax professional. But these are very straightforward tax benefits. I mean, you put in $100,000, you can reduce your taxable income, on average by $70,000 to $90,000 on an annual basis initially in the first year. So you can do the math. We have a lot of Roth IRA conversions that we're doing. Many people have kind of forgotten about Roth IRA conversions, and through our planning process, we can identify what your RMDs are going to be within reason based upon current assets every single year. And so we can show you that if you have a larger IRA, $500,000, million, 3 million, 5 million, whatever that number is, you are going to pay significant taxes. And not only for you, because if we can get that money into a Roth and utilize a strategy alongside of it that can greatly reduce the additional taxable income that you're going to have to pay for that conversion, well, all of a sudden, we're bringing you something that I don't think any other advisor, certainly in the Chicago market, probably the Midwest, is going to bring you that kind of an idea. Doesn't mean it's right for you, but it's something to look at, especially when you look at the taxable income for larger IRAs. I don't think advisors have done a good enough job of showing clients, investors, what those RMDs, especially the RMDs, are going to do and how they are going to increase your taxable income, your tax due at a period where you don't have any more cash flow coming in. And so we want to mitigate that. So 630-492-1912. So if if you have a larger IRA and you want to make sure or you want to talk about Roth conversions, you're not doing the Roth conversions because of the taxable income that would happen during that conversion process that worries you, well, we may have an option, and we want to show that. It just really becomes a math equation. So 630-492-1912. Brian is doing just a phenomenal job of the financial planning, and the tax software is absolutely just second to none. And again, we're not CPAs, but I think this brings us as close to, well, let's just say that, in my opinion, it's the most efficient way to manage taxes when it comes to investing and it comes to conversions. And it's generally cost prohibitive for the investor to go out and get that software. We obviously are going to cover that cost as a firm, and then you have access to it. So it's certainly something that you want to talk about. But back to missing the market run, and many people, especially into the election, what's going on with interest rates, and yes, interest rates are are high and going higher is our belief. You look at inflation. Who knows how or why they thought inflation was down fourth quarter of last year. I don't know if it was politically or what the reason was, but that certainly didn't seem to be the case. So many people thought, and rightfully so, that a correction had to come. But it didn't, and it hasn't. And it doesn't mean that it won't come tomorrow. I mean, the reality is that the markets are going to go down again at some point. We will see a 20%, 30% correction again. It's just when. And we want to make sure that our investors, that you are protected against significant loss. And so when we talk about kind of protected growth, we do a lot of banknotes. I know that we talked an awful lot about that. Last week, we priced 2 on Friday. One was over 11.5, and it had 30% downside protection. And so the indexes that note tracked, I think that was BMO that actually, that was a BMO note. I can't remember exactly, but it was either, I think it was BMO. But anyways, 11.5, I think it was priced at 11.6. And you get that 11.6 on an annual basis paid monthly as long as the indexes that note tracks are not down 30%. Would you be surprised that there are investors out there that aren't happy with that for their protected growth money? It's shocking to me. Absolutely shocking to me that people, when we look at kind of protected growth. And so again, we believe protected growth plus, and then tax reduction / alternative. Look at what is going on in the bond market. And if you look at the bond market is now in the worst drawdown in history. And so you have an investor that, because you can't be 100% equity. My goodness. I mean, it's like, does that make sense? I mean, it just doesn't. What I've found is that people who are super aggressive, they're super aggressive when the market's up. And then when the markets are down, they're wondering why they were super aggressive. So you have to have some defense inside of a portfolio. And our strategy on the defensive side is the banknotes and the 5-year indexed annuity. And you say annuity, and it's like, oh my God, they're terrible, right? Well, I think the income annuities have an issue. Now, I think I probably wouldn't, it's hard to find a use case in most situations for the income annuities just because of everything that we've talked about in the past on the radio show. And, you can, if you have not heard me in the past, just go and listen to all my podcasts. We do podcast every episode of this, and you can listen to, our thoughts on that. But on the protected growth side, it's very reassuring to know that you have investment backed by the largest banks with the best credit in the world, and you're going to get X as long as Y doesn't drop 30%. That's a really, really strong story. But when the markets go vertical, people all of a sudden think, wow, 11.5 or 12 or 13 or whatever it is isn't good. It's like, my goodness, man, that to me, that line of thinking is very troubling. It's very short-sighted, and it's going to, my belief, has caused them real issues when it comes to compounding wealth. And then we also use that 5-year index annuity, and the index annuity doesn't have any fees. It pays us a commission. I think the one that we use, I have not found another 5-year that paid less, and that's a good thing. Now, the commission comes from the insurance company, of course, but if a commission pays less, generally speaking, I think they put that money into the product for the client. And so that, to me, is very important. And it kind of goes back to many individuals missing, the market. And so what we use is a bond alternative. That's where we use the index annuity for, as a bond alternative. I don't think it's an equity replacement, even though since 99, it's beaten the S&P at a 10% cap, which is, kind of surprising to a lot of individuals, but it's that old slow and steady wins the race. But this one is simply 100% principal protected on an annual basis. If the market's down 1 or down 50 or 100, your return 0. And currently, the one that we are using, you get the first 10.25% of the S&P 500. So if the S&P is up anything to 10.25, you get 100% of that return. Anything above 10.25 that you don't get. So you're capped at that. that strategy would have probably helped people stay invested and not worry about a big crash. So there is a use case there for that strategy. Now, again, for us, it's just a piece of the pie. It's the protected growth bucket. So we're not trying to model out equity returns, even though historically it has given equity returns, but it's but then, we want to make sure that we have other strategies that can really get after it. And we'll go over that after the break. So 630-492-1912, 630-492-1912.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. We are fiduciary, and here's the deal. We are not for everybody. How's that? How many advisory firms are going to tell you that we're not for everybody? And here's who we are not for. We're not for those people that want 100% of the upside with absolutely no downside risk. And would you be surprised that there are people out there that are disappointed with significant returns simply because you have some protected growth that brings down the total return slightly? And it just amazes me when we talk with individual investors. We just see all types, and it's who we are for is we are for individuals that believe that a correction will come at some point, and that they want to look at being proactive with their quote unquote safe money. There's options, and in those options we were talking about in the first segment, the bank notes, and we priced one on Friday, and again, it was, I think 11.5, 11.6 with 30% downside protection, backed by a really, the big banks, them, JP Morgan Chase, BMO, Citi, Bank of America, Morgan Stanley, et cetera. Again, my mission is to make sure that individuals know that there are investments that can deliver positive returns in the market to a point. That is something that you have to know exists today. And if you're not working with an advisory firm that is at least sharing those investment ideas with you, then you're with what we call a dinosaur advisory firm. You're with a firm that is just doing some level of stocks and bonds, and we know what your performance is, and it's, you're probably not happy about it. And you cannot let advisors say, well, your plan modeled out at X return, and you're beating your plan, so it's okay to greatly underperform the market. You can't do that. You can't, at least in my opinion, you can't do that, because the financial planning software, there's a cap on what we can really model out as returns. And, that's probably a good thing. So you don't have, investor advisors out there kind of showing just absolutely positively unrealistic returns. So, we have to talk more about performance. We have to talk more about the fact that you can outperform the market. The industry doesn't talk about performance. The big advisory firms generally will do everything in their power not to talk about performance. They'll talk about service. They'll talk about planning. They'll talk about anything and everything other than performance. And there's a reason why. And the reason why, in my opinion, is that most advisory firms claim to be proprietary. And again, it could be $1 billion, $10 billion, $20 billion, $50 billion firm. It does not matter. The size of what one manages or a firm manages, you cannot equate that with good performance. They could, but that doesn't mean anything. And generally, what you're going to find is the larger the advisory firms, the more reliant they are on asset allocated models, and that is, again, it's just going to be an issue. And so we want to shine the light back on performance. We want to shine the light on underperformance from advisory groups. I don't think that they should be getting paid what they're getting paid to just let clients consistently underperform just because a plan has a targeted growth rate of 5, 6, 7%. So that should make you happy. So 630-492-1912, 630-492-1912. So this year we have a real focus on performance. We have a real focus on showing you what your true performance is. Fees, not so much. I mean, fees to me are what they are. Nobody works for free. We're getting paid. Everybody, knows that advisors are getting paid. And it's it's embedded in the investments. You don't see it. Others, it's straightforward. We're on that straightforward side. Everybody signs an advisory agreement doing three things. They have discretion, so they allow us to manage the money. They sign your fee. So sometimes people forget. And so if you're listening and you're a client, it's always good to just revert back to the advisory agreement because you can see exactly what the fee is. And then, it's just the fact that we have to act in a fiduciary capacity. And again, a lot of this doesn't mean a whole lot until we see a market correction. I saw really interesting statistics this week that the market has never been so weak under the surface. And this is actually going back to the end of January. So these numbers slightly have changed, but I've been meaning to talk about it on the show. And again, just like I was talking about how thinly traded, or not thinly traded, but how concentrated the market is, that does not mean that we're going to see a correction. That doesn't mean that just because the markets have never done something that it's going to give you an automatic, sell-off. And we have to be very careful with statistics. Generally, individuals are going to follow statistics that support their thoughts, their cause, and that can be really, really dangerous in anything, but especially in investing. So only 29% of the S&P 500 stocks have outperformed the index in 2024 and 2023. So in other words, I guess another way to look at it is 71% of the stocks have gained less than the S&P 500. That is a similar occurrence to what happened in the 1998, 1999 dot-com bubble. It again, doesn't mean that we're going to see a big correction, but I want you to start thinking, what defense do you have in your portfolio? You have to ask yourself, what strategies do I have in my portfolio that if the markets go down, that I can still deliver a positive return to a point? And if you don't have those strategies in place, if you can't readily point to what those are, chances are you don't have them. And if you call your advisor and you ask, what strategies do I have in my portfolio that will do well in a down market, they may not, and they probably can't point to them. They'll probably talk about bonds, but again, don't listen to me. Just go and look at what your bonds have done. You're looking at, on the bond side, most aggregate bond funds are delivering at a 10-year number under 2% a year. Under 2% a year. And advisors are still holding bond portfolios or bond allocations and strategies in clients' portfolios. And so I want you to really think, what do you have in your portfolio that if the markets were to drop 0 to 30%, that could still deliver a positive return? And if you don't have anything, I want to know why. I mean, you have to think about why, but even more important, you have to reach out and, just do some due diligence on the strategies that are out there that exist that can deliver those positive returns in the market, in a negative market. So 630-492-1912, 630-492-1912. Because generally bear markets pale in comparison to bull markets. Obviously, not only in movement and duration, but I've seen the charts too. And you have a lot of people that put these charts in front of clients that, show that, bull markets happen so much more often and for so much longer than bear markets. And I get it. But that doesn't mean that we shouldn't have something in the portfolio that can still deliver positive returns if the markets go against you. And my concern is that, you look at timing, right? Because when you're working, while I would never just, buy index funds and just blindly invest in index funds or ever work with somebody that, basically used index funds, because you don't need to pay an advisor to use index funds. I mean, you can do that on your own. Seriously, I think is the best way to manage your money. Then don't pay the advisors 1% to 2%, because 1% to 2% of outperformance is significant, absolutely significant. So, we talked a lot about our growth strategy, our bucket, sleeve, swim lane, whatever you want to call it, strategies of how we manage money. And our growth bucket is a money manager that we use that has outperformed the S&P 500 by it's about 1.6 to 1.7% a year since 1995. Now, again, that's past performance, right? And I have to say past performance is not indicative of future results. But you look at 1.5 to 1.7%. Most people don't think that that's a big number. Over time, that's a cumulative outperformance of the S&P by almost 1,200% if you just did nothing, did absolutely positively nothing. You sat it and you forget it. So this whole adage that, you can't outperform the market, you can, and you absolutely can. The advisors want to stay away from talking about performance because they're underperforming in many instances, in some instances significantly. And so, that is, something that, again, like I mentioned in the first segment, that we're going to talk about. So nobody, debates that, the markets go up over time. I mean, they absolutely positively go up over time. That's why, I personally believe it's the single best wealth generator, that there is, but there also are periods of weakness. And when we look at portfolio management, again, our aggressive growth bucket, that manager that we use, third-party money manager, net of fees, since 15, averaged 25% a year. Again, aggressive growth, right? So it may only be 3%, 5%, 7% of a portfolio, but it's phenomenal for Roth IRAs and IRAs. But 25% versus the S&P at just over 13 over the last 10 years. Again, past performance. We don't want to make investment decisions on past performance because, candidly, it doesn't mean anything about what's going to happen in the future. So we have to just use it as a gauge. So you can outperform the market. And I see far too many people not have aggressive strategies in their portfolio because they're not set up on that protected growth side. And again, it doesn't matter how old you are. It doesn't matter, when you're retiring. I mean, if you have a 3 to 7% allocation in something that really has some high octane and has, again, based upon quantitative analysis, mathematics, algorithms, and has really proven to be able to get after it, what a great strategy as a complement to your current portfolio to really, overcome, some of the weakness that, we may see, in the market. When you're up so much, you just have more, you're playing, with house's money. And so nobody thinks that the markets are not going to go up. But I want to leave you with one statistic before, we have to sign off for this segment. If you had bought Microsoft in 2000, it took you 14 years to get back to even. That is a long, long time. And what if we're in that market now? What if we are in that market now? Because nobody knows. And so many individuals are near retirement or in retirement that if we do go through a sideways market, man, it could get really, really interesting unless you have strategies that can still deliver those positive returns in negative markets to a point. So with that being said, any questions that you have, please give Paige a call today or this week. We'll set up our initial consultation, share with you what we're doing, learn about what you're doing. If we can help you, fantastic. So 630-492-1912, 630-492-1912. Welcome back. You're listening to Destination Retirement. Thank you for listening to the show. We see the podcast numbers. We haven't been really good at updating the podcast. We've been so darn busy. Commitment is to make sure that each week it is updated. So hopefully you'll be able to listen more, but we certainly like to see the numbers go the direction that they're going. It means that I think our message is resonating. Our message is, resonating that there will come a time where the markets are down again, and there will come a time that the quote unquote boring investments that can still give low double-digit returns with 30% market downside will be very appreciated that they're in the portfolios. And I get it. It's hard to, when the markets just, are up 25, 30%, people can look at, it's only done 11, 11.5, 12, 12.5. Well, guess what? That is for your safe money. That you have to look at when we look at kind of investing, we have to look at what is the purpose of the investment. And that's one of the reasons that we're so focused on making sure that we have distinctly different strategies in a client's portfolio, whether it's like the protected growth, for example. Our philosophy has always been for our protected growth money, if we could get equity returns for that money, equity-like returns for that quote-unquote safe money, man, we're doing something really, really good. And you have to see down the road. You have to look at, you can't compare that protected growth bucket to equities because that's not the benchmark. I mean, the benchmark should be AGG. It should be, the aggregate bond index. And when you look at the aggregate bond index, I mean, the performance on that has just been atrocious. And I see just far, far too many advisors that are still utilizing stale, boring, old, antiquated asset allocated models because it's easy for them as a firm to scale. It's easy for them to manage $1 billion, $5 billion, $20 billion, $50 billion, whatever that number is. And guess what? That just means more in fees. And that's great for them, but is it really good for you? So we believe that, for that protected growth money and like that 5-year index annuity, and we were talking about, we talk annuities are a hot button, obviously. And, there are good ones. And we think the good one is the one that we're using. I just see far too many people buying these guaranteed lifetime income annuities, and they don't understand what they're buying. If you're being told that, an insurance company is going to, give you guaranteed growth at 6%, 8%, 10%, come on. Nobody's going to give you guaranteed growth at that rate. Now, they'll give you that for income purposes, no doubt, but that's not real money. And I see far too many people thinking or being led to believe that that's real hard dollar money that you can ultimately take with you if and when you decided to leave. And the problem with those strategies is the insurance companies know that they're going to give you just enough growth. They're going to limit your withdrawals. And they know that you're not going to take that account to zero in most situations. So you basically are only taking your own money out until the account goes to zero. And actuarially, I think the insurance companies are pretty smart. I think they're pretty smart to know that the markets are, give you a little growth, limit your returns. Chances are you're never going to go, to that, down to that negative market. So when we say annuity, the annuity that we use is that 5-year, we call it, the growth annuity. It's a strategy that is tied to the S&P 500. And in any year the markets are down, you can't lose. So there is no negative return, and it's capped at 10.25%. So you get that 10.25% currently. That's at least the cap, and it's tied to the S&P. And so don't think that just when I say, because I hear a lot of people talk about, when they call in and they want to reach out and they say, well, I know you don't like annuities. That's not true in any shape or form. We just don't like the wrong ones because that 5-year annuity, 10.25% on the S&P, so you get 100% of the first 10.25%. It's a mouthful, right? The price movement of the S&P, you don't get the dividends. That is a darn good strategy for many people to have a piece of the pie. And I bet that would have kept a lot of people in the market and probably have significantly higher values than, currently what you have, in a portfolio today, because, the markets just had to go down. In those lifetime income annuities, we have to remember what inflation does to fixed distributions. They may be sold as is that you can get a increase in income. I mean, they may show you that on paper. I don't know if I've ever seen it in actuality. But you have to think about inflation, and we do talk an awful lot about inflation. And you had car inflation. Well, I mean that inflation numbers came out last week, and they're incredibly hot. So I don't know what inflation really is, based upon the stated inflation or what real inflation is, but it's been reported. Car insurance is up, 11%, transportation 7%, repair inflation 6%, utility gas 5%, homeowner inflation 5%, rent is up, food obviously is through the moon. And so when you have an investment, any investment, it's why everybody doesn't like, I guess, for lack of a better phrase, Social Security. Social Security is guaranteed income. Downside to that is it really going to keep up with inflation? I mean, yes, you get a, COLA, which is at least something, a cost of living increase. You don't even get that with those lifetime income annuities. And so you have to really look and dissect what that cash flow is going to mean to you 5 to 10 years down the road. And that is my biggest concern. So I think when you have other investments that can produce significantly higher cash flow with, you just have to look at it, and you have to really think about it. So if you have an annuity that has a lifetime income component, that's okay. Let us help you. Let us look at it. Let us really dissect, what that cash flow will look like 3, 5, 7, 10, 15 years, 20 years down the road. Many people will say, well, I don't plan on using the income. Well, then why did you buy something in an annuity that has a governor on the growth for something that you're not going to use? And so that's why, we look at, that 5-year annuity. It's just, again, it's pure growth. When the insurance company doesn't have to hedge for guaranteed income, they can kind of let the horses run a little bit more. And so the growth is going to be higher. And that's just the way those things work. So 10.25% of the S&P on that 5-year is currently the best that we have found, with a very strong credit rated company. And so if that is something, especially for those CD buyers out there, man, I just, again, let's tie something to the S&P. And let's, get that cap at, 10.25 currently. And let's really look at it and see and have a very thoughtful discussion on, are you giving up just too much, for that, to have that CD? And you may not be, because every investment obviously is different, but it's our job to really point out. And I've always thought that if the portfolio is constructed correctly, where you have some money you can't lose, some money that you can't lose, and actually you'll still make money to a point like negative 30 on the broader markets, more than not, people are going to be okay with the growth and the aggressive growth bucket of their portfolio. It's just not set up correctly from the beginning. And that's something that we talk an awful lot about, is that portfolio construction. It doesn't matter how old you are. You can be 70, 80, 85, 90. Why doesn't that mean that you shouldn't have 3%, 5%, 7% in an aggressive growth strategy that has just absolutely destroyed, the broader S&P 500 over the last 10 years? So I think it just becomes, the fact that you don't have it set up correctly from the beginning. And it comes down to these asset allocated models. And we'll talk about the target date funds after the break. So 630-492-1912, 630-492-1912. If you'd like to have a conversation this week, get with Paige, and she'll set up our initial talk. More after the break.
Planning for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. We're a fiduciary located in Naperville. So if you are in the Chicago area, well, it's really easy to work with us. If you are in the Midwest, it's still as easy to work with us. If you are anywhere in the country and you want something a little bit different, if you want defined outcome investing, if you want investments that can still deliver positive returns in negative markets to a point, then we're going to be a good group that you should probably talk with. We have the beautiful technology of Zoom conference calls, and we do have clients, in really all over, and so we do get to travel, which is nice as well. So 630-492-1912, 630-492-1912. Tax time. One of the most overlooked area, possibly the most overlooked area, is proactive tax strategies that individual investors that are accredited. Accredited means $1 million net worth, not including your primary residence, or $200,000 single, $300,000 joint over the last couple of years, with the high predictability that you'll continue to make that money into the future. That is not my accreditation. That is not my requirement. That is the SEC's. But if you are accredited, if you meet that criteria, we talk about these at our dinners. We need to talk more about them on the radio. We do. It's just so frustrating to me when we are obviously growing as a firm and hiring another admin. We hired one certified financial planner. We're going to be in the market for another one, just to make sure that we're bringing to the table what we believe to be the best planning alongside of the best investments. When we're meeting with other advisors that are looking to leave their current firm, one of our questions that we ask them is, share with us kind of your tax management strategy. Share with us strategies that you implement for clients that can have some sort of a tax advantage for them. And again, we're not tax professionals. We can't give tax advice. And anything that we talk about regarding taxes is truly for informational purposes only. We think that we're right when we talk about them, of course, but it's always best practice before you make any decision for any reason to talk to a professional that is a specialist in that area. But when we ask those questions, share with us kind of, your most proactive tax management strategy, generally what we get is tax loss harvesting. And listen, these are advisors at major Wall Street banks, major Wall Street firms, and that is the most proactive they're going to get, is to sell some investments that have losses to try to match your gains. Now, that's good. Don't get me wrong. I mean, that I would just think should, it's like kind of just like during the day, well, you have to breathe, right? Well, I mean, I think that would just be something that is understood, that we're going to try to match gains and do some level of tax loss harvesting. But that's not proactive. And a couple things, like I've mentioned throughout the show so far this year and today, we're going to really hit performance, and we're really going to hit tax strategies, and we're going to hit financial planning. Those are our three hot topics that if you don't want to hear about during the radio show, then just tune me out, because I'm going to sound like a broken record. But we see far too often that investors with over $1 million, $5 million, $10 million, $20 million, they think because they're at a big bank or a big brokerage firm that they have the most cutting edge strategies when it comes to tax planning. And that, unfortunately, is not the case. And so a couple questions that you need to ask your advisor, and they'll kind of give you an idea if you're with a very forward-thinking risk registered investment advisory firm. Number one, what strategies do I have in place that can deliver positive returns if the markets are down? I want to see it. I want to see the strategy. Show me. The markets are down. These are predefined strategies. If the markets are down 30% or less, you're going to get paid X. That's a positive. Those are the banknotes issued by the largest banks, most strongest financial institutions, banks in the world. I want to know that. If your advisor cannot answer that question, then you need to reach out. 630-492-1912. Second question. I want to know what strategies that we can talk about. Doesn't mean you have to invest in. What strategies can we talk about that can greatly reduce my taxable income? So if I invest, let's just use $100,000. How can I reduce my taxable income, active or passive, by on average $70,000 to $90,000 in the year that you invest? You have to ask that. You have to ask, can you show me strategies that if I invest $100,000 that I could reduce my taxable income, active or passive, by $70,000 to $90,000? If they don't have those strategies, then you're working with an advisory firm, a bank that does not have the most cutting edge. I don't care what the name of it is. I don't care if you see them on TV 24/7. That means absolutely positively nothing to me. It's just like reviews. It's another hot topic that I need to talk about, which it frustrates me. So many of these reviews are, they're just not what you think they are. There are review services out there that I could use that we could have massive 5-star reviews at all times. Would you believe that there are services that you send an investor a questionnaire or review, and if the review is not positive, it doesn't go on the website? That's what those services are. I could buy that. So I've gotten away from, when I see a dentist or a doctor's office that has hundreds of thousands, or, you get the point, many, many, many reviews, generally speaking, those are not accurate. And I tend to go to ones that, don't play that review game. That's why I've never asked a client, at least to date, I guess I could change my mind tomorrow, to go and leave public reviews, because they're just not worth it. What we would rather do is, if it's needed in a compliant way, we can certainly give you references of current clients that you could talk to. I think you're going to get more out of that anyways. But I went down kind of a rabbit hole there. But again, taxes. So if you don't have a real proactive tax strategy that can reduce your taxable income, you're missing out. Trump is pro-energy. You hear drill, baby, drill, drill, baby, drill. Love him or hate him, it doesn't matter. I mean, it's just, making money is making money, and reducing taxes is reducing taxes. We think there is significant opportunity in the energy space. You can go out and buy the common stocks of these energy companies and get the dividends and the principal protection, no tax benefits. Or you can invest in funds that invest in oil and gas drilling directly alongside of these companies, and you get significant tax benefits and relatively high, I would consider to be relatively high targeted distributions. We'll just call them double digits. Could be high double digits, could be low double digits, but our target is double digits. And I think that's very achievable at current oil prices. But you're going to get massive tax benefits. And that, to me, is proactive. That, to me, is an advisor that looks at the most cutting edge, and I even hesitate to say cutting edge, because these tax benefits of oil and gas investing have been around forever. But that's what working with a an independent fiduciary registered investment advisory firm is going to bring to the table. Now, again, some of those strategies are great. Some of them are garbage, but we want to talk about how we can reduce your taxable income. If you are a high wage earner, a physician, an attorney, earning, 7 figures. Now that's not the requirement, but if you're, multiple 7 figures, if you sold a business, if you had some liquidity event of some sort, if you have concentrated stock positions that you have significant embedded gains and you don't want to sell because of the capital gains, let's talk. If you have large IRAs, doesn't even need to be a large IRA, but if you have IRAs and you're trying to convert to a Roth and you want to do it as tax efficiently as possible, as long as you meet that accreditation standard, we can have very, very meaningful, proactive conversations in ways that you probably have not had in the past. 630-492-1912, 630-492-1912, because again, may not be a good investment for you, may not be appropriate for your situation, but you should at least check that box. So those are the things that we're going to continue to talk about each and every week. When you listen to us, we want to bring proactive strategies to the table. We want to get you to think. We want to get you to understand that asset allocated models in volatile times, I think you're going to be disappointed. I think they're phenomenal for the advisory firm because candidly, they don't do anything, and they're very easy. Anytime you talk about new investments, that brings in a level of uncertainty. That's just human nature. And that's okay with us because you work with an advisory firm, again, to do a couple things. Make sure your plan is in place. Make sure you have the foresight that you're not going to outlive your money. Most people we work with, that's not really the issue. But the financial plan will really give you that, how can we be when it comes to tax planning? How can it be when we come to Roth conversions? Let us show you how for a legacy that if you convert, that you can convert 1 times, 2 times what you thought tax-free to the next generation. If that is not a main, concern or something that you want to talk about, well, then let's talk about how when you have to start taking those RMDs, or if you're currently taking those RMDs, how can we mitigate the tax due on those RMDs? People don't understand. If you have a 7-figure IRA, which many, 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 many people do, those RMD taxes that you're going to have to pay are going to be significant. And it's going to bump you, generally speaking, to a much, much higher tax bracket than you think, which is some proper planning and looking at, the Roth conversion story and having an investment to couple that with that can reduce the additional tax due from that conversion. All of a sudden, everybody should be picking up the phone and reaching out to us. And I can't even believe I just said that, to be honest, because it sounds like the craziest, corniest sales line there is. But you know what? The truth is what the truth is. And it's that planning process that we're able to really help with and show you year by year what your anticipated tax is going to be and how we can max out, that current tax bucket with Roth conversions. And again, you have set, 3 million, 5 million, 10 million in an IRA, you really need to reach out. So 630-492-1912. So I want to thank everybody for listening this week. Hopefully you got something out of the show. Now that we're into coming up upon, we're in the middle of the first quarter, going forward, we're really going to bring, we're going to talk an awful lot about performance, tax reduction, financial planning, strategies that can make money in negative markets. That's our goal for this year. And so if that interests you and you want to learn more about what we're doing, we'd love to speak with you this week, next week, or a convenient time for you. So give Paige a call, 630-492-1912, 630-492-1912. More next week.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com. This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment
Planning
advisor.
for retirement is kind of like planning for a trip of a lifetime. First you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, KuhnCP.com.